Welcome. In this video, we will analyze what happens if Xcn coin rally comes. Don't forget to subscribe, like, and please watch to the end to understand. When we look at the chart from a broader perspective, one of the most notable structures is the descending trend line formed as the price has moved downward at a certain angle over time. This trend line has been tested twice in the past and has been confirmed by the price. In both instances, the price touched the line and was subsequently rejected, resuming a downward trajectory. This shows that investors view this area as a strong zone of selling pressure and tend to open short positions when the price reaches it. However, one of the key principles known in technical analysis is this: the more a resistance or support line is tested, the more likely it is to weaken over time. At this point, we have a descending trend line that has been tested at least twice. This has not only formed a technical structure, but has also become an important psychological boundary for market participants. If this line is broken to the upside, it would indicate that the ongoing pressure in the market has dissipated and that buyers have taken control. The most critical point to watch here is whether the breakout is strong and confirmed. In other words, merely piercing the trend line with a wick may not be sufficient. On the contrary, a volume-supported bullish move with a candlestick close above the line will confirm the validity and strength of the breakout. If such a breakout occurs, market sentiment can shift rapidly, potentially resulting in sharp upward moves. Investors often interpret such breakouts as the beginning of a rally. Especially when structures like descending trend lines are broken, this typically generates a buy signal, according to many technical strategies. Additionally, in such descending trendline breakouts, technical analysts usually look at previous key price levels, Fibonacci extension ratios, or resistance areas in high-volume zones to determine targets. So, if this trendline is broken, the price may not only escape current levels, but also initiate a significant upward move to test a series of technical targets. The momentum of this move can accelerate depending on the trading volume at the time of the breakout, momentum indicators like the RSI, and overall market sentiment. While the price is still moving below the trend line at the moment, each upward attempt brings it a step closer. If selling pressure weakens and buying increases as the price approaches this level, the likelihood of a breakout strengthens. This type of situation is often referred to as a compression phase in the market, and compressions typically lead to sharp moves. If this scenario plays out, the price could soon find itself much higher, testing previous resistance zones. In short, we have a descending trend line that has been tested twice in the past and is now preparing to meet the price again. A breakout of this line could signal the end of the current downtrend and the beginning of a new upward wave. Since such breakouts are extremely critical from a technical standpoint, it's very important for investors to remain cautious and alert at this stage. But looking only at trend lines is not enough. We must also consider other metrics for a complete analysis. Stay tuned. When we carefully analyze the chart, we can see a highly distinct and technically classic reversal pattern beginning to take shape. This structure is known in technical analysis as the double bottom pattern, or more commonly referred to as the W pattern. The main characteristic of this formation is that after a period of decline, the price finds support at a certain level twice and tends to reverse upward. This technical structure is an important signal that the market has encountered strong buyers at a key support zone and that the selling pressure is diminishing. The current price movements we are analyzing on the chart are clearly signaling this classic W pattern. In the initial phase, the price experienced a sharp drop, then found support at a certain level and began to show upward reactions from that point. This movement formed the first half of the pattern, the first bottom. The upward move from this level generally indicates that investors are starting to recover, and the price is experiencing a temporary relief. However, this rise typically stalls at what is known as the neckline, the midpoint of the pattern. In the second phase, the price begins to pull back again and is currently trading near the level of the first bottom. This area marks the critical zone where the second and final bottom of the W pattern is forming. This second bottom is extremely important in technical analysis because buying volume and investor interest often increase again at this point. It can be a strong signal that the downtrend is coming to an end. If this pattern completes in its classic form, it is expected that the price will rise strongly from the second bottom to test and potentially break the neckline level. This breakout is typically supported by an increase in trading volume. If the neckline is broken with a bullish candle and strong volume, it confirms the W pattern and sets a target based on projecting the vertical distance between the first bottom and the neckline upwards from the breakout point. Furthermore, looking at historical charts, it has been observed that the upward movements following these types of W formations often lead to trend changes and result in long-term positive price action. Therefore, Closely monitoring this developing pattern is of great importance for investors. If the price clearly forms the second bottom and the anticipated breakout occurs, it could present serious profit opportunities in both the short and medium term. In short, the W formation currently taking shape should not only be seen as a simple technical pattern, but also as an attempt by the market to redefine its direction. During this process, investors who act with patience, caution, and strategic moves will significantly increase their chances of success. When we analyze the chart, we can see that the price has recently managed to break above the 200-day exponential moving average, EMA, a highly significant technical indicator. This move can be interpreted not just as a short-term bounce, but also as a clear sign that market participants are regaining confidence and that a shift in trend direction may be underway. The 200 EMA is closely watched by both individual traders and large institutional players, serving as a key reference line for identifying the overall direction of the market. The fact that the price has moved above this average, which typically acts as resistance during bear markets, suggests that this level could now start functioning as a potential support. Such breakouts are often followed by a pullback, a move commonly referred to in technical analysis as a retest. These pullbacks are generally seen as healthy corrections that pave the way for more sustainable upward moves, helping to confirm the strength of the breakout. The current approach of the price back toward the 200 EMA indicates that the market is looking to test the validity of this breakout. A strong momentum had previously been established when the price first moved above this level. However, by nature, markets rarely move in a straight upward line. Therefore, this pullback toward the 200 EMA should not be seen as a cause for panic, but rather as part of a structural formation. This revisit to the level increases the likelihood of the price finding support, and the reaction at this point will be crucial in determining the next direction. If the price tests the 200 EMA from above and manages to hold this level, especially if long wicks or strong buying volume are observed, it would indicate that buyers are regaining control and could initiate a new upward impulse from this area. This would represent a significant buying opportunity for both short-term traders and medium to long-term investors. At this point, volume should be closely monitored, as the behavior of volume around a technical level is one of the clearest indicators of whether it will hold as support or resistance. Looking back at past price action, we have seen the 200 EMA act as an effective barrier many times. Each time the price approached this level, it either reacted strongly or went through a lengthy consolidation before any breakout. Therefore, the current retest suggests that the market is once again reassessing its psychological boundaries. In technical analysis, such levels reflect not only chart data, but also investor emotions, decision-making moments, and risk perceptions. If the price successfully holds this level and bounces higher, it would not only confirm the continuation of the current uptrend, but could also lay the groundwork for targeting new highs on higher timeframes. In summary, the price currently trading near the 200 EMA marks a critical phase in terms of technical analysis. If buyers regain dominance at this stage, it could signal not just a short-term recovery, but the beginning of a much larger uptrend. Therefore, investors should closely monitor this level, pay attention to potential pattern formations, and watch volume behavior carefully. Price actions forming around such major moving averages are foundational to technical analysis and often produce significant breakout or reversal signals. The 200 EMA must be closely followed. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.